Video clip will introduce how to trade the stock with the margin account. But before starting the Excel exercise, class Excel exercises, I want you to read the textbook and read the class, the notes first, in order to understand these terminologies. Okay, so let's get started. So here we have input variables, initial equity owner investment, that is indicated here. How much is initial investment? Right, $10,000, right? $10,000. Again, here the point of this exercise is to find, at the end of the day, here, ROI with the margin or without margin. When the ending price changes, what would happen in the return on investment? And also, we want to see a margin based on the ending price, because it provides some percentage of the margin, maintenance margin, and initial margin. So let's finish first the input variables, and then we'll continue the next part. The amount borrowed here can be complete once we complete this input variable section. So let's continue here. The initial stock price the investors can invest is the 50, right? And then ending stock price, let's assume that the ending stock price is now the 40 here, right? And cash dividend per share is 60 cents per share. Initial margin percentage is given the 50%. Initial margin, that means, in order to buy certain amount of the initial investment, you can put your money on this investment account only 50%, and then the rest of this 50% you can borrow. Maintenance margin is 30%. 30% means your initial investment portion must take at least 30% of your total investment. When the market price goes down, and then your total investment, including borrowing, is definitely decreases, even more decreases, because you leverage your investment. So maintenance margin, which is your portion below the level of this 30%, and you can put your money up to the 50% initial margin again. Once you borrow money, here you must also pay, right, interest, 8%. The holding period in month is given 6 months, right? 6 months. So let's put 6. So here, how much amount can we borrow? Right? If you put 10,000 and the initial margin is 50, then you can use this function here. Your investment divided by 50%. This is total amount you can invest using the money borrowed, and times how much percentage, the 50%, and then you must subtract your initial investment, your own equity portion, right? So that we can calculate. If the initial margin is, let's say, 15%, let's say, then you can invest. If the initial margin is 10%, and then you can borrow $90,000, and you can invest your own money, only the $10,000, right? So in this case, 50%. We are building a model of the margin account. So total amount is now, you can sum this up. Shares purchased. Now shares purchased at the stock price of the $50,000. How many shares? Now the 20 total investment divided by, right, the initial investment. So you can buy the 400 shares. So we finished this setting up. Now let's calculate return on investment when the stock price went down to $40 from the $50 when we use this margin account, initial margin with this 50%. So capital gain, how to calculate capital gain? Right, this 400 shares times 50 minus 40. Now this capital gain or loss, to do so, I want to make it negative because the price went down. So $4,000, the capital gain so far, the investor lost. How about the dividend? Dividend is positive. How many shares? 400 times cash dividend, so 240. Interest on a margin account. How much interest? This is minus because we pay, right? Where is the interest rate? There you go, right? 8%. How much is the borrowing amount? Right, 10,000, right? So 10,000 times 8% times how long month? Right, 6 months. So divided by 12. So $400 interest. So let's all this up. Then net profit margin. Net profit is now 4,160. Losing 4,000 dividend received and pay the interest. What is the initial owner investment? Right, this $10,000, right? So how much percentage we lost? So 4,160 out of 10,000, the 41% is lost, right? ROI without margin, if we didn't use this the margin account, then just simply forget about this interest. We can just only consider the 40 minus 50, and we need to now add, right, this cash dividend and divide by initial stock investment. So negative 18.80%, right? So that shows a huge differences margin, right? If we had initial margin only 10%, if I put the 10% here, what happened? Right, the huge loss, right? Huge the amount of loss. 50% initial. Now we'll provide some data table here. If the ending price go up and down, what happened to the price changes and ROI with the margin, without margin? We can provide these ranges to the investor. So let's link this with the margin, 41%. This, the without margin. So when I drag here, we put, you guys remember the data table. What if analysis data table and column, what do you want to change? The price change, which is ending stock price. Here we go, right? On the column ending price changes, okay? And it shows the percentage change, return on investment, right? And so that the investors can be noticed. Okay, so what would happen if the stock price go up and down? It's $5 the interval, and what would happen on my return on investment, right? Without margin, the same process. What if data table and go to the input variable cell, and here the ending price, and okay, and it automatically generated, right? But the point of this exercise is to indicate, is to find, is notify the margin based on the ending price. What is my the current margin? What is the percentage of current margin, right? So we need to understand this process as well, right? So that the investors can notify how much is the portion now of their investment. What price when they receive the margin call, when this their initial portion reaches to 30%, then they definitely want to know the stock price when they got this margin call, right? So first, let's calculate here. Now, percentage margin, ending equity investment over ending value of the investor's share, total investor's share, right? So that is the percentage margin. Is that right? And then how to calculate ending equity owners investors, shares times ending price minus borrowing, which is equity owners investment portion, divided by shares times ending price, total investors shares, right? Ending value. So here, now, How do you calculate? Right, the shares 400. Shares 400 times $40 ending price. What I'm doing is this equation, right? And minus $10,000 borrowing. And divided by 400 shares and 40, which is the shares, all the shares times the current value, right, of the investment. So that we can get, the margin, current margin, which is the investor's own investment, investor own the portion of the total investment is 37%. Still, okay, has a room to reach this 30% of the maintenance margin when the stock price went down to $40. What about the price when they receive the margin call? That means now we can apply here on the percentage, instead of 37.5%, we put this 30% on here on the ending on the percentage margin, right? Then we have an ending price, which is the objective we want to calculate. We only one variable here, ending price, and then we have the 30% ending the shares, the borrowings, which is known. Then we can get this ending price by rearranging this the equation. The borrowing divided by 1 minus percentage margin, which is 30%, times number of shares. So let's calculate the price when they receive the margin call. So here the borrowing 10,000 divided by, open the parentheses one more, 1 minus margin call, how much percentage? Yeah, 30% when they receive, times how many shares? 400 shares purchased, and close the parentheses. And okay, there you go. $35. If the margin call occurs, that means the price now went down to $35.71. That time, now the investment portion is now only the 30% out of the total investment. So this model provide investors some outlook, the forward, what would happen if the stock price now went down to $35, let's say. $30. What happened? Right, it's ROI, and the ROI with the without margin decreases. Here, margin based on the ending price, $30, only 16%, right? Because the price went down to $30, which is below the level of this price when the investor received the margin call at the 30%. So, yeah, this is really important exercise. As an investor or as a broker or the advisors, we provided this margin account tables. So see you guys on the next slide. Bye-bye.